So one issue that I already touched upon is how investing in individual stocks can be risky. Like say we're going to invest in the stock market for the first time. We're excited, so we decide to put all our savings into Tesla stock. Tesla seems like an amazing company. They're producing electric cars, which are becoming more and more popular. But for some reason, 1 year later, Tesla goes bankrupt, the company has a shutdown. All of a sudden, its stock price goes to $0. And unfortunately for us, this means we lose a lot of money. Even if a company doesn't go bankrupt, its stock can actually lose a lot of its value. When I started investing, I was like, oh, I want to make a lot of money, so I'm going to take more risks. I ended up listening to random YouTubers and invested in random stocks because they said those stocks are going to quadruple, 10x, 20x in price, and I was like super excited. I put almost $2,000-$3,000 in these random stocks. So long story short, I ended up losing all of that $2,000-$3,000 I invested in these stocks. I guess those YouTubers' predictions were so bad, and all these stocks kept going down in value. What I want you to take away from this is that you are going to be no different than me. If you invest in individual stocks, you can get lucky and make a lot of money. But at the same time, you can also lose a lot of money as well. If you balance out the gains and the losses, you won't be making a lot of money in the stock market. To add to this, most of us don't have enough time to find the right stocks and don't want to deal with that stress anyways. My philosophy is that investing should be simple and straightforward. So the solution to all this is to invest in a lot of stocks through index funds. When we think about index funds, what we're really thinking about are indexes like the S&P 500. Essentially, indexes are a special grouping, imagine like a friend group of stocks. Some stocks can be part of a lot of friend groups and be part of a lot of indexes. Others you might only find in 1 or 2 indexes. That being said, indexes are made up of hundreds or maybe thousands of stocks. And when we invest in an index, we're actually investing in all those hundreds and thousands of stocks at once. And this is amazing because it allows us to diversify. Diversification with regards to investing in the stock market is essentially to invest in many different stocks to reduce the risk of us losing money in the long term. Like if we invest in all the stocks you see on the screen, even if some stocks go to zero or loses a lot of value, all our other stocks might be increasing in value, and this means overall, our investments together will still be increasing in value. And this is the power of index funds. It allows us to invest in the stock market without having the risk, the hassle, and the stress of investing in individual stocks. You may have heard of mutual funds before. Mutual funds and index funds are not the same thing. Mutual funds are actively managed by professional fund managers. This means someone is trying to pick stocks they believe will perform better than others. Because mutual funds are actively managed, they often come with higher fees because you're paying for someone to pick stocks for you. However, studies have shown that most actively managed mutual funds don't consistently outperform the market in the long run. Index funds, on the other hand, are passively managed. They simply aim to replicate the performance of a specific market index. Since there's no active stock picking involved, index funds have lower fees and are generally more cost-effective for long-term investors. So that's why personally for me, I prefer and I believe that investing in index funds is a way better strategy than anything else. Now that we established that we want to invest in index funds, which index fund should we invest in?